In this video, I'll show a data-driven technique to find support and resistance levels implemented with Python. This technique extracts support and resistance levels from the market profile. The visualization you're seeing now shows the closing price on the left and the current estimation of the market profile on the right. The market profile is a charting technique to show where price spends the most time. The market profile is calculated using the last 168 closing prices. This is hourly data, so 168 is 1 week of data. The significant peaks in the market profile are marked with red dots, and the lengths of the orange lines beside the peaks are the prominences. We'll go over what the market profile is and what peak prominence is in the video. The motivation of this technique is based around the idea that support and resistance are levels in price where price is slowed or stopped altogether. With this definition, if we find levels where the price tends to spend more time, then the price is slowed at those levels or revisits those levels often, and thus those levels are support and resistance. As an example, let's look at hourly Bitcoin Tether data in 2022. Here is a histogram of the prices over the whole year. We can see that a chunk of closing prices happened here at 10.3, and on the price graph we see that price spent a chunk of time sitting at this level. This histogram is the market profile, but a histogram is not the best way to represent how price was distributed through time. A histogram groups prices into a number of bins, and the representation is blocky. It's hard to pick out exactly where the peaks are. A better way to represent the market profile is with a kernel density estimation. Here's the kernel density estimate plotted in red on top of the histogram. We can see that they have the same information, but with the kernel density estimate, we can more accurately pinpoint the peaks in the distribution. Kernel density estimation is more computationally intensive than the histogram, but the added accuracy makes it worth it. This function constructs the market profile with a kernel density estimation and finds the prominent peaks in the market profile. As input, it takes an array of logarithmic closing prices and the current logarithmic average true range. It also has a few parameters to control how the market profile is constructed and how the levels are selected. The first part of the function creates weights for each price in the data given. These weights are used by the kernel density estimation, but ignore the weights for now, we'll talk about them in a moment. This line uses the SciPy function Gaussian KDE to get the kernel density estimate. It returns a callable function, we save it as kernel. The kernel density estimation has an input called bandwidth. This controls the smoothing of the distribution. We use the average true range multiplied by a constant to serve as the bandwidth. We multiply it by ATR mult, which is one of the input parameters in the function. Here is the market profile with ATR mult values of 1, 3, and 5. We can see that as the multiplier gets larger, the distribution becomes smoother and there are less peaks. 3 seems like a good compromise to me, but setting the bandwidth optimally is difficult and there's typically some subjectivity into it. It's always a trade-off. After this line, we use the kernel to build our market profile. To do this, we find the minimum and maximum price in our input data. We create a grid of 200 prices equally spaced from the minimum to the maximum. Since we are using logarithmic prices, each price in the grid has a constant percentage increase. A different number than 200 could be used. You get more accuracy with a higher number, but at the cost of more computation time. I think 200 is plenty enough, and perhaps it's even overkill. Then we assess the kernel at each price in the grid. Our final market profile is held in the variable PDF. This is what I'm actually plotting for the market profile that you're seeing on the right. Now let's talk about the weights that we ignored earlier. Up until now, our weights for each input have looked like this. All ones across the entire set, equal weights. The prices at the very beginning of the data factor into the construction of the market profile just as much as the most recent price. In trading applications, we're primarily concerned with what the price is going to do in the future, off to the right of the chart. The most recent price is the closest to the future prices temporally. The price 1 hour ago probably has more to do with the future price than the price 1 year ago. The market profile should respect this, so we employ time weighting. The time weighting is controlled by this parameter, first W. If first W is set to 1, then equal weights will be used. If it is set to 0.5, then the first price, the price furthest in the past, will have half the weight of the most recent price. We set up the weights by finding a step size that linearly increases the weights from the first to last over the length of data. In this line, we create the weights. Here's the plot of the weights at various values of the first W function parameter. If the first weight value is set below 0, then the data furthest in the past has no influence on the market profile. We floor negative weights at 0. I don't think a negative start W is useful, as you can just pass in less data. While probably not very practical, setting the first W parameter greater than 1 will actually weight past observations higher than recent observations. Here are the market profiles constructed with different time weightings. All of these have an ATR mult of 3. Now we can look at the last part of this function, actually selecting the levels. We will use a technique from topography called prominence. The peak selection is controlled with the function parameter prom_thresh. The minimum valid value is 0, which means there is no prominence filtering. Let's look at the peaks with no filtering. Each peak is marked with a red dot. I'll plot each peak's prominence with orange lines coming down from the peak. As you can see, some peaks are very pronounced and obvious, while others are little bumps that might just be noise. Prominence is calculated by looking at the neighboring points around the peak and finds the minimum value on either side of the peak. The higher minimum on either side is called the lowest contour line. The difference between the peak and the lowest contour line is the prominence. On the graph, you can see that the bottom of the orange line corresponds to a local minimum. SciPy already has prominence implemented for us, but if you want more detail about this calculation, the SciPy documentation has what you're looking for. I'll link it in the description. In the code, we find the max value and multiply it by the prominence threshold to get the minimum value for prominence. We call the SciPy function find peaks using our minimum value. Finally, we loop through each of the found peaks and add the price to the list. We exponentiate them to get the actual price values, as again we are using logarithmic prices. Here are the peaks selected with different values of the prominence threshold. As it gets higher, only the most significant peaks are selected. These prominence values could be used to rank support and resistance levels by significance. I have not yet done the research necessary to speak more on this idea, but I think it's a cool idea. So perhaps there will be a future video utilizing support and resistance ranking if I find something interesting. At this point, we've only found support and resistance levels in sample, given a set of data. These found levels are only available for real-time use on the last point of data. We can't cheat by using future data, so to use these support and resistance levels in a trading strategy, we need to perform the entire procedure we just went over in a rolling window. This is what the visualization I'm showing now is doing. The levels drawn are recalculated with each new price. Let's look at the code for this. This function handles the rolling window. It takes a data frame with open, high, low, and close prices, and the lookback to calculate the support and resistance levels. The same parameters from the previous function are also passed in. We find the average true range with the given lookback. This is using the pandas technical analysis package. We create a list the same length as the input data to store the found support and resistance levels. We loop through each candle in the dataset. We get the most recent values and convert them to logarithmic prices. We call the find levels function, which we already went over, then save the current levels. This function will return a list of lists. Each candle has a list of the current support and resistance levels. That's it for the support and resistance algorithm, but now I'll show a very simple trading strategy that utilizes it. It is a trend following strategy. When the price penetrates one of the lines from below, we take a long position. When the price penetrates one of the lines from above, we take a short position. This strategy always has a position in the market, long or short. Let's look at the code for this. This function takes a data frame, the open, high, low, close data, and levels, which is the list of lists, the support and resistance levels at each candle, the one we got from the previous function. We create a signal array for each price in the data. We keep track of the current signal with this variable. We loop through each candle. If the current support and resistance levels are not available, we continue. We get the current closing price and the last closing price. We loop through each of the levels. We check to see if the price has penetrated the level from below. If it has, we set the current signal to 1. And we check if the price has penetrated one of the levels from above. If it has, we set the current signal to -1. 1 means a long position and -1 means a short position. We save the current signal to the signal array. This strategy works well with longer-term support and resistance levels. We'll test it using daily Bitcoin data. We use a lookback of 365, which is 1 year, to calculate the levels. I used a time weighting of 1, equal weights. This way, longer-term support and resistance levels will be found. We set the prominence threshold to 0.25. Here is the cumulative log return of this strategy. Its performance is okay. The win rate of the strategy is quite amusing. Long trades have a win rate of 20%, but the average winning trade is 190%, and the average losing trade is -5%. The short trades also have a win rate of 20%. The average winning short trade is 30%, while the average losing short trade is negative 4%. There's only 39 trades in total, so I'll just display them here. Pause if you want to look. This isn't a very good strategy by any means, but it shows the support and resistance lines the algorithm draws have some potency. I'll be making more videos using this algorithm in the future, and perhaps I'll make more videos showing some other methods of finding support and resistance levels, as this is certainly not the only way to do it. That's it for this one. Thank you for watching.